Good day, everyone. Welcome to GDS Academy. And our topic for today is on accounting concept and convention. I'm going to make this to be in a simplified form. Alright, so we are still under basic accounting process and system. And this is our topic for today. So yeah, contrary to this is an updated material for our basic accounting process and system, and these are basically what they are going to test you, or what they can test you on this diet. So you need to pay attention and focus on this video. So in accounting concepts now, I won't say much of this and I'll try to be as brief as possible. Accounting concept and convention is under conceptual framework. It's like a guideline in conjunction with ICAN. You understand? So the accounting concept convention combined with the principles of accounting, rules and laws and regulations together all comes together to form what we call generally accepted accounting principle. Yeah, so that is what comes together to form our what we call gap. So it varies for different countries, you understand? But with the adoption of IFRS, it has reduced. IFRS aims to what? To make one standard applicable to the nation as a whole. So that's the goal. But with the help of IFRS, it has helped to reduce the number of gaps for each country. So it has streamlined it a little. But with time, I guess it will work harder. So IFRS is International Financial Reporting Standard. Alright, without wasting much of your time, let us dive in. So what is going concern concept? So going concern concept, it is the concept that states that an entity will continue to operate for a foreseeable period of time. Now what do they mean by that? They mean that a business is being established with the goal that it will continue to operate. That is, they are not anticipating any form of cessation. They don't plan to cease operation of business or to liquidate. So that's why they say to continue to operate for a foreseeable period of time. You understand? Let me say perpetuality, indefinite. Yeah. So once you can explain your concept and your points like this, then you should not have problem with going concern concept anymore. The next one is money measurement. So money measurement concept is talking about recording items or transactions that can be presented in monetary terms. That's one. It's also talked about the currency. So that's why you see in some of our financial statements, the currency is very important. You understand? Especially when you begin to advance a bit to professional level or to advanced level, you see more reasons why where money measurement comes in. It talks about items capable of being recorded in monetary terms, and the currency. The currency is also important because if you do not record it in the right currency, then the financial statements can be misleading. Yeah, so that's what for money measurement. Then consistency concepts. Now we know that we have various methods of preparing financial statements, especially let me streamline it to when we deal with non-current assets. That is, when we want to deal with our depreciation, we have various methods. So consistency concepts is that when you select a particular method, you should continue to apply that method in subsequent period, with the exception that with the exception of it's not making your financial statements to be in a true and fair view. That is, when it is not faithfully represented, or you know that the continued usage of the old method you mislead the user, then you are allowed to change the method. So consistency, this talks about what choosing a particular method and sticking by it. For example, maybe you pick a depreciation. For example, you pick depreciation straight line method in presenting your depreciation, then you should continually use what the straight line method, unless it is stated otherwise that continual usage of straight line method will make your financial statement to be what not presentable or to be misleading. Alright, that's for consistency. Then for prudency, prudency talks about you not anticipating your income and or your profit. It says that profit or income should not be anticipated. Rather, you make provisions or allowances for unforeseeable loss. So an example of this is receivables. You know, when you are not sure, there's no guarantee that all your debtors are going to what pay back. So instead, you make provision. And another example is inventory, where some item becomes, or some goods rather, become obsolete. You understand? So you make provisions for stuff like that. That's what they call prudency. Another name for it is conservatism concept. Now, materiality and aggregation. In short, without wasting much of your time. So materiality is talking about items or transactions. Let me put it that way. Let me put it this way. It states that an item is said to be material if the omission of it will affect what? If the omission of it will affect the decision of the user of financial statement or accounting information. So an item is said to be material if it is misstated. That is, when you did not record it in the appropriate way, or you record the wrong figure, it will affect what the financial statement, and hence will influence the decision of the what accounting users. Another thing is about materiality and aggregation is items that are of significant value should be treated what separately. That is, you do not aggregate those ones that are significant, that are very significant. You record it separately. For example, a statement of financial position, known as balance sheet before. You see, they separate the assets. Even the assets, they divided it into two again, where you have your non-current assets and current assets, because it is very significant. It's very important you separate them that way. Then other ones where you have just minor expenses, you can what? Categorize them together. Since they are not what? Material, then you can aggregate it together as well. Now the next one is accrual and matching concept. Now, although they tag them together, but I would love to separate them. So for accrual concept states that income is recognized when it is earned and not when received. Expenses is recognized when it is incurred and not when was paid for. So that's brought about what we call accrued income and accrued expenses. Then we have prepayment also. So we have accrued expenses, accrued income, we have prepaid expenses and prepaid income, or they call it payment in advance, or they call it deferred payments, or deferred income, or deferred expenses. So this is divided into income and expenses. But when we get back into this, when we are dealing with end of the year adjustments, then I will dive deeper into this and explain it, giving you both T format and straight line, vertical rather, so that you can get the concept behind it. Now for matching concept is talking about you matching the income and the expenses of our business in the same period. Now what do I mean by that? It means if you want to get the profit for the year 2025, you can only match the income recognized for that period and the expenses recognized for that period to get the profit for that period. So which means you must have made some adjustments here to either deduct or to add the amount earned or the amount incurred for that period. Then after you've done that, you compare and get what the profit for the period. That's what matching concept is talking about. So once you understand all these concepts and conventions, then it will be easier for you when you want to prepare your financial statement, or should I say it will be less difficult for you when preparing your financial statement. Remember, you are still going to read your notes. The purpose of you coming here is for me to explain what it means. And besides, even if you have not read it before, you can still understand it and put it in my word, and you still get your mark for it. Now, objectivity and fairness. So objectivity states that your financial statement should be prepared in a way that it is not being influenced by third party. Now the third party can be your management. You understand? It must be independent. Your financial statement should be free of personal bias. Let me put it that way. So it must be free of personal bias when preparing your financial statement. Then fairness, although they mix them all together, but I'm just trying to separate it. For the fairness principle or concept, fairness is talking about you preparing your financial statement in a way that it is not targeted to any financial users. Now let me come again. You prepare your financial statement in a way that it will not favor a particular part of the user and neglect the other. It must be kind of neutral. So your financial statement should be prepared in a fair view. That is, you are not preparing it so that it will favor any particular segment. You prepare it in a way that it will favor all, to be fair to all. Alright, so now we are done with objectivity and fairness. Although another thing is take note, all this objectivity also prevents fraud and also ensure that financial statements are being faithfully represented. Now, historical cost. Historical cost. So historical cost, it is the amount of cash or cash equivalent or fair value consideration that is being given in exchange for what? Property, plant and equipment. That's non-current assets. You understand? Or you can also say it is the amount of cash or cash equivalent that is paid to acquire inventory for resale. You understand? Now, the inventory for resale is different from an inventory that is used for construction or building something, but that is not really part of what I really want to discuss for in the scope of this topic. You understand? All these are is a topic on its own. We can also say inventory is the sorry historical cost rather. You can also say it is the amount of proceeds received in exchange for an obligation. That is in terms of liability. You understand? So the amount that you see in your non-current asset or your asset or liability is talking about historical cost. That's why I did not limit it to non-current asset only. Remember, accounting keeps getting broader and wider. So for you to have an understanding, we need to explain to you guys this way. So it can also be in form of liability as well. That is the amount of proceeds received by the entity, you understand, in exchange for an obligation. Now, the reason why I said an obligation, it might not necessarily be cash. It might be other ways that you can pay back your for the proceeds that you enjoyed. Now, fair value basis. Now, this fair value basis is also broad. It is under International Financial Reporting Standard 13, IFRS 13. They call it fair value measurement. But I'm just telling you this so you know. Alright. So fair value basis is the price that will be received. Fair value basis is the price that will be received from uneligible parties to sell a property, plant, and equipment. It is the word price that will be received from a knowledgeable party. There's a difference. They are aware of the information of the price rather of the market or formula. So fair value basis is the price that will be what received from an eligible party at an arm's length. That is, they don't have any relation, they are unrelated, to sell Price, okay, let me give you the point. Received from a knowledgeable parties at an arm's length to sell property, plant, and what? Equipment, or the consideration to pay what? An obligation. The at between market participants at measurement date. So let me come again. Fair basis, fair value basis, or fair value. It is the price that will be received from a knowledgeable parties at an arm's length to sell a property, plant, and equipment, or to transfer what? You can either say resource or considerations to what? Market participants at what? At the measurement what? Date. So that's the definition for what? IFRS 13. They call it fair value measurement, but yeah, they call it fair value basis. It's just for you to understand what it's talking about. You understand? The amount that you received to what? To what? When you want to sell an asset, or when you want to settle a liability is what we call what? Fair value. Now, periodicity. Remember, in our going concern, we said a business will continue to operate for a foreseeable period. Now, we need to put in period in which we record, or we need to give in a period in which we are going to prepare our account. You understand? So the periodicity concept is talking about what? 12 months. So 12 months, that is not necessarily January to December. So 12 months is talking about accounting period. So 12 months is an accounting period, not necessarily January to December. So you have to be careful. They might trick you guys in answering question like it must be a 12 months. You understand? An accounting period for A entity might be different from the accounting period for B entity. So an accounting period for A entity might be from, let us say, March to February, that's 12 months. Or it could be from what? October to September, that's for entity B. So that's the goal of what? Periodicity concept. Now, offsetting. Offsetting is talking is another name for offsetting. That they call it, you can also call it contra entry. That is, you use of the amount of your assets to offset, that is to settle what? Your liability. It is allowed, although there are some scenarios whereby these are prohibited. But our when we have our international financial reporting standard, they have the procedures for each standard being given. But generally, that's what offsetting is talking about. You use an amount for, because in some cases it could be between receivables and payables, that you use your receivables to sort your payables. There are different scenarios that applies to this. Now, relevance and faithful representation falls under qualities of accounting information, but I will get back to it. Now, substance over form. Substance over form, also known as reality over legality, is talking about recording an item in its economic substance rather than in its legal form. For example, let us use lease. Although when you lease a property, or let's say a land, from a lessor, legally the land still belongs to, depending on the type of lease though, the land still belongs to what? Ownership still remains with the lessor, but the economic use, the permission to use it, and how you can make use of the asset falls with the lessee. So you record the economic part. You understand? The economic part of the lease agreement overrides the legal form when you are preparing your financial statement. That's simply what they meant by what? Reality what over what? Legality. Another similar example is when you rent a space. Although the apartment or wherever you rent might not be for you, but you need to record it because you've made payment for it and you are going to make use of it for the business. So therefore it's the substance overrides what the legal form. You understand? Now realization concept, although similar to Akura concept, it's talking about revenue when it is earned. So now this realization concept, you'll be making use of it also in what we call IFRS 15. But sorry I'm letting you know this, but it's good you know it now. IFRS 15 is revenue from contract with customer. So it says that revenue is recognized when earned, you understand, and not when received. So when do you recognize revenue? You recognize revenue when goods or services have been transferred or have been enjoyed to what? To your customer. That is when your customer have what? Incur liability. You understand? That's what realization what concept is talking about. I repeat, when goods or services have been transferred to your customer and he has enjoyed it, then you can recognize what? Revenue. It does not necessarily mean when he paid cash to you. Alright. Entity concept, sometimes it is being called business entity concept. It states that a business should be treated as a separate entity from the owner. That is, GDX, for example, let's say GDX is my name, then GDX is not the same as GDX Academy. So GDX Academy is the name of the entity, while GDX is just a person. GDX Academy is an artificial person, while GDX is a real person. That's what business entity is talking about, and that is where the concept of drawings comes from, and the likes of capital, equity. Let me put it in that way. Although there are other various sources, but I'm just using it to link it with this because the amount that you use for your business is not the same thing as the amount that you have for your personal use. You understand? That's why whenever you withdraw money from the business, it will be treated as drawings and they deduct it from what? Your profit. If you do not have profit, they'll deduct it from what? Your capital. You understand? So that is for what? Entity concept. Alright. So I'll be wrapping it up for today. I would have loved to talk about relevance and faithful representation, but I'll be doing that in our next class, and I will explain it under qualities of what accounting information. So thank you, and that's all that we have for you today. Kindly like and subscribe to our channel. Like our video, can ask questions and we will attend to it. You can also share with your friends that are struggling with what? Basic accounting process. Thank you very much. See you in our next class.